All right, so once again, here's your practice questions number 2, which is this is the study guide for the midterm exam. Okay, so this is actually, I think it's about 54 questions. So again, this is just extra practice for you, so you guys can understand what are questions I could ask of you on the exam. So here's a section that we are familiar with. I am going to be asking you, I believe 5 of the questions are going to be, I will give you an account name, and your job is to determine the type, the category, and the normal balance. Now, in this case, we've gone through this, so now that we are interested or introduced to newer accounts, making sure that you're able to determine the type, determine the category, and determine what kind of normal balance this is. So in this case, right, that's what part 1, part 2, and part 3 does. Here are your options, okay? So account types, there's only 5, right? Assets, liabilities, equity, income, and expense. And then, of course, your categories are here. And then, of course, the question is it going to be a debit or a credit? Okay, normal balance. So let's go ahead and go and through all of these, okay? There are 15 we can practice here. So number 1, what is checking?
Asset current debit.
Yes, it is a current asset, right? Because it's in its simplest form. And yes, it normally would have a debit balance. So again, utilize your accounting model to determine what kind of account balance would you normally see when you have a checking account. What about accounts payable?
Liability current credit.
Good, right? We know when we owe our vendors, right? Usually we owe them within a year, right? 30, 60, 90 days, depending on what kind of supplier or vendor that you're seeking from, okay? But usually it's usually done within the year. So in this case, it is a current liability. So, and because using your accounting model, you'll know that liabilities are normally increased with a credit. Good. What about inventory?
Asset fixed and debit.
It is an asset, but it's definitely not fixed. It doesn't fall under the property, plant, or equipment.
Okay. What are the categories again? Can you move it down? I can't see it. I can't find mine. Inventory.
Mm-hmm.
I didn't think it was current though.
Why would you
But
not think it's current?
it's a turnover one. It's a short turnover, so it would be current.
Correct, because
No wait.
we based our assets based on how liquid or how easily convertible it is into cash, right? In this case,
Right.
let's determine why it's not a fixed asset, right? It doesn't fall under property, plant, or equipment, right? Property, is
Oh,
it part of land? No. You're not
yeah.
selling your land. Is it plant? So is it part of the building? And is it part of
No.
the anything that's inside the building? No. And then
Oh,
last but
see, I
not
was
least,
thinking equipment when I said when I was thinking inventory. I thought equipment in
all
my
right.
head.
Okay, so in
That's
this
what.
case, right, inventory is items that we sell. In this case, you wouldn't be selling your equipment unless you are like a retail store for equipment, then you wouldn't identify those as equipment. Those aren't things that you're
Right.
using to operate your business, right? You're not using those inventory to operate your business. You're using inventory to sell. And in this case, exactly what you said. And if we're selling our inventory, that means within 24 hours, I can go ahead and sell whatever inventory item I have, right? And get cash from it instantly. So in this case, it is a current asset. Okay, and what kind of normal balance would this normally have?
Inventory is a debit normally.
Yes. Good. Okay. All right, next is supplies expense.
That's an expense, an overhead, and expenses are normally debit.
Yes, now we don't have an overhead account. What do we have?
Oh, operating, sorry.
No worries. I understand it. Overhead in this case, yes, this would be overhead, but we're not in costing. We're not in costing accounting right now. We're in financial. So in this case, it's an operating expense. Yes. All right. And normally, you're correct. They are normally debited. You look at the accounting model, it is usually debited. Okay. What about an accumulated depreciation? An accumulated depreciation. When would we ever use accumulated depreciation?
Well, it's a contra asset, isn't it?
Correct. Correct. You answered it perfectly. Yes, it is a contra asset account, right? This is directly correlated to your fixed assets, right? So in this case, if it's a correlation to your fixed asset and it's a contra account, right? You just said contra asset account, so it is an asset. And I just said depreciation only derives from fixed assets. But in this case, it's a contra account. So what kind of normal balance would this typically have?
Hmm.
It's credit because it's the opposite of normal positive balance.
Excellent, right? Because when we acquire our fixed assets, right, we increase them because that's what we're told, right? We're told that if you're going to acquire a fixed asset, you're going to debit that account. But if this is going to supposedly be a decrease, a depreciation, right? You're decreasing the value of your fixed asset, then what direction would it go? Right? Think about when you actually are journalizing depreciation expense, right? Where would the credit where what would the credit count be? It would normally be your accumulated depreciation. So in this case, yes. And on top of that, the word contra means opposite. So in this case, it would flow in the opposite direction as the main account. Okay. What about bad debt expense?
It's that took the other there's account.
Good. It's an expense account.
And then I thought it was a temporary account, so I thought it was a current.
Okay, so again, there of under expenses, there's no such thing as current expenses.
Oh, okay.
Right? Expenses only have 3 categories. What are they?
Operating expense.
Mm-hmm.
Hold on. And what was it? Cost of goods sold, operating expense, and a non-operating expense.
Good. So out of those 3, what would a what would a bad debt expense do?
Operating expense.
It would be to the operating because where does the bad debt derive from?
Selling the item.
Yes, but what is a direct correlation to create this bad debt? Yes, you're selling the items, but what is the bad debt? What causes bad debt?
From your account receivable.
From your accounts receivable. So in this case, which is your main core of operations. Good. So in this case, it is definitely going to be an operating expense. Now, what kind of normal balance would a bad debt expense have?
Yeah, but
Yes, because it's just a regular expense, right? So you would treat it like a regular expense. So in this case, it would be normally debited. All right, I have another inventory in here, so we can skip that one. Okay. Next one. What about unearned revenue? Unearned revenue. Revenue you haven't earned yet.
I think Marcy said in the class, it's a service that we owe to the customer, so it's a loan.
It's not a loan.
Oh, liability, I mean.
Yes, yes, yes. There you go. Perfect. A liability because you owe services to a customer, right? General rule of thumb, this derives from when a customer gives you a payment ahead of time.
Yes, that's what Marcy said. It's we owe the service to the customer, so it's a liability.
Now, what kind of liability would this be?
It's current because we are supposed to provide the service in short term.
Correct, because I mean, I know there are some liabilities out there where you have to pay a little bit ahead of time to reserve, like for instance, right? You go rent out a venue. They're going to require you to put a down payment on the venue to hold the date, right? That could be a year in advance. But most cases, when you pay somebody, right, to do a service for you, you expect them to complete within a year. You're not going to wait a whole year for the services to be complete, right? At that point, they might forget about it. So in this case, yes, it's most likely going to be current because it's expected to, the service is expected to be completed within a year. All right, and what kind of normal balance would this have?
it's a credit because it's a liability.
Excellent, right? It's a liability, and because it's a regular liability, right, you are going to credit it. What about accounts receivable?
That's a current asset.
Yes, it is because it's in terms of to a customer, it's IOUs. So if a customer owes you money, how do you get the money quick? Well, you either bill them, call them, and get the money. So in this case, what kind of normal balance would this have?
Yeah, but
Mm-hmm. Right? Because you can easily, it's an asset, so we're going to most likely increase our accounts receivable. Okay. What about furniture?
it's an asset.
Yes, it is. What kind of asset?
Well, hopefully you don't have to get rid of it every.
Mm-hmm.
Oh, excuse me, I got a dog barking. Hold on.
Okay. What is furniture? What kind of asset is furniture?
It's current, isn't it?
Well, you did answer your question, right? You wouldn't
You
need to get rid of it or sell it right away.
long term either, like a loan is.
Well, I'm okay, but in this case, right? Tell me, if you bought a furniture and you used it, right? How quickly can you convert it into cash?
Oh, it takes a while, so it would have to be long term then.
There's no such thing as a long-term asset.
Oh well. What are the ones for assets? My head's screwed up.
Yeah, so in this case, yes, you're on the right terms in that case, but we don't categorize our assets based on length of time. We categorize them based on how liquid they are.
Fixed would be not liquid
Why would fix not be liquid?
because fixed is kind of a permanent type thing that doesn't it's not permanent, but do you know what
Can
I
you
don't know what I'm trying to say.
can you still sell your furniture to get some kind of money out of it?
Yeah,
So it is liquid.
just not really short term.
Not short term. right? You can there's no quick way to turn it around and get cash for it. So what are the categories of assets? There's three.
Current, fixed, and other.
Okay, so we already determined it's not current.
It's not plant.
It's not plant.
It's not plant or land. So
Well,
it has to
actually, wait, go back. Sorry. It's not property, right? It's not land, right? Like you just said. But is it part of the plant?
it's part of the, yeah, and it's part of the equipment type stuff. So
Well, I
it would
mean, you
wouldn't
wouldn't necessarily use furniture as a mean of operating your business, but
right.
you are
But
in the
what is
right area. It is part of the plant, right? It's the building and everything that's inside the building. So that means desks, lamps, fixture, furniture, tables. Those are all considered plant. So in this case, it's a fixed asset.
didn't I say that in the beginning?
You said it was
Or did I
not
say
a
something
fixed
else?
asset. You said it was not. It can't be a fixed asset.
I know fixed got in there somewhere.
Yes, because you were explaining to me that there's no way this could be a fixed asset, and I was
Yeah.
like, why not? I asked you why not. So in this case, it is a fixed asset because again,
Right.
you can sell it, but the
Yeah.
turnover around time is not going to be very. You're not going to get it right away. And on top of that, another way to determine whether it's a fixed asset is to go through the PP&E. Is it property? In this case, no, it's not. It's not land. It's not the streets. It's not the sidewalks. Not the parking lot. Is it a
Is it
plant? Yes, it is because the plant is going to be the building and everything inside the building. Okay, so that means furniture, tables, lamps, chairs, desks, right? And it doesn't fall under equipment because it's not any type of machinery that helps the company produce anything or operate in means of, like, for example, a printer, a telephone, right? A computer. Those are more operative because they are kind of some kind of machinery. So those are things that are going to be considered equipment. So that's how you could tell between using that PP&E test to see if it's a fixed asset or not. Okay. So there you go. Good. It's a fixed asset. So what kind of balance would this normally have?
Debit.
Yes, it will have a debit balance. Okay. What about owner's withdrawal?
Equity.
Yes, it is an equity. Now, what kind of equity?
Not retained.
It is a contract account to the owner's equity, isn't it?
It is a contra account. That is correct.
And then owner's equity doesn't have any category, so it's blank there.
Good. None. None of the above. So good. So good.
And then since it's a contract, so it's opposite to the normal election. So debit is the positive.
Good, right? Because in this case, right, would an owner's withdrawal increase or decrease equity?
Decrease it.
Right, because you're taking money away, right? You're not adding any contributions to the net worth of the company. That's what owner's equity is, right? It's the net worth. So if you're taking money away from the company, is that any means of increasing your equity? No. You're deliberately hurting your business by taking money away. So in this case, since it's a contra account, it would normally have a debit balance. Good. What about sales?
That's revenue.
Yes, it's revenue or income, whichever one you associate it with, okay? Revenue or income. Okay? Now, what kind of category would sales fall under?
listed under sales.
Yes, because sales is the main core operating income, right? So I'll accept if you know it either or if it's operating income, yes, that's true. But in this case, because we are looking at a merchandising type of business, your only operating income is going to be your sales. So in this case, yes, I have it as sales. Now, what is the normal balance of sales? What was it?
Credit.
Yes, good. Okay. What about cost of goods sold?
It's expense.
It is an
account
expense account, correct.
in the category of cost of goods sold.
That's right. COGS is where it belongs.
And then because it's expense, it's debit and
Yes.
positive.
Good. What about depreciation expense?
I took it as expense because it said expense.
Yes, good, correct, right? Most cases, that's what you look for is if you see the word expense, you're going to automatically associate as an expense.
And then depreciation expense, I took it as, oh, where is it? Operating expense?
Yes, correct. Because again, cost of goods sold is directly correlated to your inventory and your sales. So in this case, does depreciating your fixed asset have anything to do with your sales or inventory? No. So in this case, you only have two more options. One is operating income or operating expense or non-operating expense. In this case, I used my fixed assets, which helped me either produce or help me do something that's in the business, right? So in this case, it would definitely be operating, right? And what kind of normal balance would this have?
Because it's expense account, it's debit.
Good. Okay. Last one is going to be allowance for doubtful accounts.
It's a contract asset.
It's a contra asset account, so definitely it's an asset. Now, what kind of asset is the allowance for doubtful accounts derived from?
Comes from the accounts receivable, so it would be current.
Yes, right. This one comes from the accounts receivable, and if it's a contra asset account, then what kind of
Credit.
normal balance would it have? Not debit. Debit is normal.
I said credit.
Okay, good. All right, I heard. Okay, good. Credit.
My mouth was full. Sorry.
No worries. Okay, so good. So in this case, because remember, we use the allowance for doubtful accounts when we see potential bad debt, right? When someone refuses us to pay us, even though they owe it to us, right? They created an accounts receivable account, but because they can't pay for it, we decided to credit the account receivable and put it into our allowance for doubtful accounts, right? And then with the allowance for doubtful accounts, decreasing the main account of accounts receivable, right? So that's why it will flow in the opposite direction, which is
And it's current because we have to clear it into bad debt expense once a year.
yes, which force it to become a credit balance. Yes.
Okay.
Good. So that was chapter 2 and 3 right there. Okay. Oh, right. Actually, that was just more for chapter 2. Chapter 3 is just more journalizing, which is basically everything else that you'll do in the rest of this test, okay? All right. Chapter 4, right? Which is also number 4. All right. Under the rules of GAAP, which rule states that when you establish a business, you need to keep your personal and your business transactions separate? C, business or economic entity. Yes, this is the exact definition, right? Keeping your personal and your business transactions separate from each other. Right? Number 5, okay? If I decide to purchase a machine for $500, okay, and in my books must be recorded as $500, okay, even if I plan on selling it for $700, Which gap rule states this?
Historical cost.
Yes, right? This is where even if you are planning to sell it, you're going to keep it in your books as whatever original price that you purchased it at. And we call this the historical cost. Good. Okay. Number six, okay? If customer A decides to purchase an item for $15.65 from your store on an account, okay, and a couple days later, right, you received a check for $15.65, you must properly record the sale and payment. Which gap rule governs this?
Full disclosure.
Not full disclosure. Full disclosure is when you have extra information that is pertaining that transaction that you cannot journalize. You have to have a separate place for it.
So would it be matching principle then?
It would be 100% matching principle because what are you matching here? You're matching. Go ahead.
How much you're matching basically the price. You're putting exactly what they bought it for and everything. You're journalizing.
Correct, right? You're matching the sales to the amount of money that you're receiving at the end of the day, right? You're matching your accounts receivable with the checking amount and the sales and so on and so forth, right? It's dollar per dollar matching here. Good. So this case, good example right here is you're matching the sales to the money that you received. Okay. Number 7, cash basis is when
the revenues are received, the cash is received.
okay.
So it would be A, wouldn't it?
Yes, in this case, yes, because in this case, letter B and letter C, right? Expenses are recorded when it has been incurred, and then the C says revenues are recorded when the sales has been earned. So in this case, those are accrual type basis. So in this case, your answer is A, right? When cash is received, you record. Same thing when you're paying for something, you only record the expenses when cash has been paid, right? Okay, number 8. Which of the following is not a step in the accounting cycle?
D.
Closing the books is step number 9 in the accounting cycle.
No, I said D.
D as
D
in
is-
dog. Okay, yes, making decisions based on your financial statements is correct because as an accountant, you don't make any decisions. Your job is just to produce the financial statements. But yes, you can have ideas. It's not like you can't, right? That's the bookkeeper, right? Who can't make any decisions, period. Where the accountant can make some suggestions, but that's only if they talk to whoever the position is for that financial statement. Like, who is this financial statement made for? So then you would express your ideas based off of that. But in this case, that is none of the steps for the accounting cycle. Right? Okay. So that was chapter 4. All right. So chapter 5. Excuse me. Number 9. What are the tracking methods used for inventory?
A.
A, periodic and perpetual, right? This one says, what are the tracking methods? How do you keep track of your inventory? You either do it on a periodic basis or a perpetual basis, right? You wouldn't necessarily keep track of it based on the years, and you wouldn't keep it track on it whether you spent money or not, and nor would you actually do it on the based on the accounting period versus the accounting cycle. That makes no sense. So in this case, letter A is correct. Okay. Number 10, okay, what are the costing methods under inventory?
D is in dog.
D is in dog, all of the above, yes, right? Because I showed you For chapter 5 and 6, we talked about the periodic inventory, and we know that the costing methods are FIFO, LIFO, and weighted average. We also taught you, right, that in chapter 7 and 8, there's such thing as perpetual inventory, which includes FIFO, LIFO, and moving average. And letter C is something I spoke about, but is not going to test you on is specific ID, right? It's where you have a specific product that is determined based on its, you know, part, right? So in this case, if it's an auto repair shop, they don't just have any kind of inventory on hand. There's no such thing as a universal plug for all cars, right? You need to determine based on car model, car year, the brand, and the exact part, right? So in this case, that's what specific ID does. So all of the above are costing methods. Okay. Number 11, okay? When delivery charges are made on COD, what does that mean?
Cash on delivery.
Yes. Okay, not code on demand, not currently orders discharge, and definitely not crate on departure. Okay? It could be possibilities, but cash on delivery is the correct one. Okay? Number 12. Okay? What is the definition of periodic and perpetual?
A.
Correct. Letter A. Periodic means once in a while, right? When you periodically check on something, you don't check it all the time. You check it every once in a while. Where perpetual means you're constantly checking up on inventory, right? Think of it in a real life terms, right? Perpetual. If you have a swinging perpetual pendulum, right? What is it moving? It's constantly moving, right? So there you go. Letter A is correct. Right? Number 13. Okay, true or false? At the end of the period, okay, under the periodic tracking method, a conversion entry is needed.
True, because that's when you get your inventory count.
At the end of the period, right?
Yeah.
So is that true or is that false?
It's true.
It's true, right? Because here, for periodic inventory, how do we recognize our inventory?
When it's counted.
Okay, let me re-ask that question. When I purchase my inventory, right? What do I recognize my inventory as? You recognize them as
Purchase expense.
we recognize them as expenses first, and then at the end of the period, when we finally have a full count of how many inventory items we have, we need to convert those expenses into actual inventory. So in this case, that is true. Okay. All right, so let's go ahead and take an example here to do a periodic inventory, okay? So here you go. Here's your scenario here where you're dealing with 100 toys, okay? So in this case, the key word here is that your tracking and costing method are periodic and it's LIFO, okay? Last in, first out, okay? So let's go through this scenario. So if on June 1st you decide to purchase 100 toys costing $1 each with a freight of $25. So what does that mean? June 1st, right? We purchased 100 toys at $1 each with the freight costing you $25. So in this case, what is my total purchase price?
$100.
Plus my freight will give me a total cost of $125. So in this case, because it's LIFO,
1.25.
I need to solve for my cost per item, which is going to give me $1.25 per item. Okay. Good. And on June 10, you decided to purchase another 200 toys costing it $1.25 with a freight of $50. Okay, so June 10, we purchased 200 units at $1.25 with a freight of $50. So what's my purchase price here?
$250,
$250 plus 50
$300.
gives you a total cost of $300. Which in this case,
150.
we're using
One-
LIFO, so we need to figure out our cost per item, which meaning we take our total cost of $300 and divide it by our 200 units. It's going to cost you $1.50 each. Okay. So then, let's see what happens on June 12th when you sold 200 toys. What do I do with this information here?
Well, we can calculate it as a part of the cost of goods sold.
Do I need to do that with periodic inventory?
No.
Good.
Well, at the end we do.
At the end, you do, right? Because you need to take a physical count to get you your total amount of items you sold, right?
Yes.
But my question is right now, as of June 12th, do I need to record this information anywhere?
No.
No, because in this
It's
case,
it's
for-
a period.
for periodic, we choose to not keep track of the items that we sell. We don't need to calculate our cost of goods sold yet. We wait till the end of the accounting period to do so. So in this case, nothing needs to be there. What about June 15 when you end up, or sorry, what about, June 15 when you purchase 300 toys? Yes, you do need to record that because we purchased inventory, right? So in this case, on June 15, if I decided to purchase 300 units, okay, at $1.50 each with a freight of 75, then what is my total purchase price?
$5.25.
Oh,
Not there. You said a total cost.
total purchase price.
Oh, it's $450.
$450 plus 75,
Make it to $5.25.
Yeah. giving you a cost per item of,
$1 and then 3/4.
yes, $1.75. Right? So then, what about June 20th? What do I do if I sold 250 units? Nothing. We skip it, okay?
Yeah, on that day.
Yep. All right, but then on June 30th, you reach the end of your inventory period. So in this case, you had a total ending balance of 120 toys on hand. So I already filled that in for you. So once we reach the end of the period, right? What do we need to do?
We have to do a conversion.
Well, first off, we're trying to solve for. We can't do our conversion entry without having all of our numbers.
Yes.
So we need to tally up our totals, right? That's what I was asking.
Oh, yes. We
Okay.
need to sum them up.
Yes. So in this case, how many items did I purchase in grand total?
600.
600. Okay. What was my grand total purchase price?
800.
800.
Yes.
How much was my total freight?
$150.
150. So that gave me a grand total
$950.
$950. Okay. So in this case, if I started out with 600 units and I have 150 left remaining on hand, what's the assumption that I sold?
450.
450, right? And again, if you really wanted to, you can cross-reference it by looking up here. I sold 200 on June 12th, and then I end up selling 250 on June 20th, which gave you 450. Okay, but that's not the point. That's not what we're supposed to do here. So in this case, I need to solve for one of the answers. So in this case, let's go ahead and solve for our cost of goods sold. So if I'm using LIFO, which batch of inventory am I going to sell from first?
The bottom one.
The last one.
Yeah.
The last one for 300 units for $525, right? And that's the total of 300 units. If I were to solve for that, that's going to give me a total of 525. Okay? Now, I just sold 300 units. How many more do I need to keep selling?
150.
You need to sell 150, right? So in this case, my last batch is eliminated. So which batch am I going to take out from next?
The $1.50.
Though 200 units at $1.50. So in this case, I'm not going to sell all 200 units. I'm only going to sell 150. So I need to figure out my calculations. What is 150 times $1.50?
$2.25.
$225.
Mm-hmm.
Okay, so that gives me a grand total of 450 units. Okay, which will give me a grand total of
$750.
$750. So in this case, it cost me a grand total of $750 to sell 450 units. Now in this case, right, how do I solve for my ending balance?
You take 750 out of 950, give you 200.
Good, right? You could take your total goods available cost, right? So in this case, my grand total of 600 units is going to cost me a grand total of $950, right? In this case, if I sold 450 units at a total of $750, I can simply subtract the two to give me my ending balance of $200, right? Or you can simply just go backtrack, look at your ending inventory, right? If I have a total of 150 units, right? I still have my first batch for 100, which cost me $125. And if I know that I have 50 units left remaining, right? If that gave me a grand total of $225, 300 minus 225 will give you $75 remaining. 75 plus 125 gives you $200. So whichever way that you choose to solve for it, that is correct. Right? So now let's answer the question. What is the total cost of the ending inventory on hand? The 150 toys.
B as in boy.
B as in boy for $200. Okay? And then question number 15. What is your total cost of your cost of goods sold?
C.
C, 750. Okay. All right, so in this case here, I gave you another example, but this time you're doing FIFO. So again, this is just practice for you. So since it's the same exact one, I'll just help you save some time here by copying and pasting this section here because the information is exactly the same. Okay, but the only difference here is I'm going to be testing you on FIFO. So again, we purchased on June 1st for 100, June 10 for 200, and June 15 for 300 for the same exact price. So in this case, I already did the work for you. So in this case, if I sold a total of, if I started out with $600 and I have 150 remaining, I should have 450. Now in this case, right, how do I solve for my cost of goods sold if I'm using the rules of FIFO? So which batch of inventory am I going to sell from first?
100 for $1 or
The-
125.
Correct, right? The first batch of inventory that I purchased because that's the rules of FIFO, right? First in, first out. So in this case, that was my very first batch that I purchased, which is the 100 units at $1.25, which we already know is going to give me $125. So there goes my first batch of inventory. So what's my next batch of inventory I'm going to take out from?
The 200 at 150.
Good, right? 200 at 150. Since I'm going to take all of it, that's going to give me a total of $300. Okay? So that means I just sold 300 units. Now I only have one batch left remaining. So how many more do I need to keep selling?
150 times the 175.
Yep, we got to sell 150 at $1.75. And what is that going to give me? All right, you could take half of 525.
262.50.
262.50. So now that I have my grand total of 450 units that I sold, what is my grand total cost?
It's going to be easiest to take the 150 at the 262.50 because that's your ending balance and you don't have to do as many calculations.
That's true. If you saw it that way first, then there you go. You could have easily solved for this much more easier. But in this case, that's what I taught you in class is use the rules of FIFO, which is going to solve for your cost of goods sold. So in this case, yeah, it's correct. If you're going to get $262.50 because 150, right? You already multiplied it. 150 times $1.75. You're still going to get 150 left remaining at $1.75. So in this case, you already calculated the work by doing $262.50. So what is your ending?
Cost of goods sold is
687.50. Good, right? So once again, answer the question. What is the total cost of your ending balance? $262.50. Okay. And what is the total cost of your cost of goods sold? $687.50. Okay. All right, and then last but not least, let's go ahead and do an example of periodic weighted average. So once again, the same exact numbers to save you some time here. Okay. Now, what's the difference between all of these other methods that I told you, right? You got first in, first out, you got last in, first out, okay? And this one is weighted average. What do I need to do? What do I?
The first, the cost of an item is going to stay the same on the 100 units because that's that. But when you get to the 200, it's going to change because it's the average of all 300 units that you've got.
Correct, but in this case, right, I'm doing periodic inventory. I can just do that at the very end.
Oh, that's true. I keep forgetting we can do it that way.
Yes, you can. So in this case, I have a total of 600 units, right? Because that's how much I purchased in grand total. What's my total purchase price? Oh, I'm sorry, total cost.
The total that is the same, isn't it?
My total cost? What do you mean it's the same?
As the 950.
Yes, that's correct. It's 950. So in this case,
So we 950 divided by the 600 units, and that gives us our cost per item.
yes, my average cost per item. Good. So what is my average cost per item if I have a grand total of 600 units at a grand total cost of $950?
$1.583333 until the end of time.
Good. So that means every item that I sell is going to cost me $1.583333. So if I sold a total of 450 units at $1.583333, what is my grand total cost of goods sold?
$712.50.
$712.50. So therefore, what should my ending balance be? Right? You'd be able to do the same thing, right? If you did 150 times $1.583333, you should get the same answer
37.50.
to good. So $237.50. Okay? So that's what I'm going to do. I'm going to try my best on the exam, which I already know, is going to be giving you the simple, easy, rounded numbers. Okay? So the only one that you won't come across is obviously your weighted average, but the end of the day, it should come out even, okay? All right, so in this case, they're 18. What is the total cost of your ending inventory on hand?
A.
Okay. And then number 19, what is the total cost of your cost of goods sold?
B.
D. Yeah, sorry. I was like looking for the answer. Okay. And then, of course, now it's asking you to also do a conversion entry. So how do I do a conversion entry if I'm assuming these are the numbers that I'm using, right? If my ending balance for my ending inventory was $247.50 and my cost of goods sold was $712.50, how do I do my conversion entry? Assuming it's June 30th.
You have purchase expense for 800, freight expense for 150.
Okay, so those are they going to be debited or credited?
Oh, those are debited.
Are you increasing your expenses or you're decreasing them?
No, that was when we put them in. We're converting, so we're going to inventory or whatever we were selling.
Good, right? Ending inventory and whatever we were selling, right? So in this case, what was my inventory item that I purchased? In this case, I told you was toys. Okay, so
Yeah,
toys.
I can remember what we got. The
And
toys for the 950 debited.
okay,
And
no.
then we credit freight expense and purchase expense for the 800 and the 150.
Okay, so purchase expense and the freight expense.
Oh, that's right. Okay, toys is
For 800 and 150. So in this case, right? Yes, it's true. We are going to convert our total into my toys, but do I still actually have all 600 units on
no.
hand?
Oh crap, we sold some of them.
We sold some of them. So then what are we going to recognize here instead?
Cost of goods sold.
Right, we sold some of them along the way. So are we actually converting all 600 units? No.
No.
How much are we actually going to convert? What was the purpose of me solving for my inventory table?
Well, it's different though based on which one you were using.
What do you mean by
So,
that?
including this last one, our cost of goods sold was different on each one. So we're only writing the conversion table for this last.
Yep, it says right here for this example, use the table and to answer the next 3 questions. So yes, I'm using this exact table.
Okay, well, I'm trying to see my numbers I had there. So we have the toys would be 237.50.
Good, because I can only convert 150 of them because that's all. That's what I have left in my inventory. And how many did I sell?
Is 712.50.
Good, because we sold 450 units. So in this case, this is your conversion entry. Good. All right. So that's question 20. All right, question 21. If on June 17, right, you received 10 broken mugs, okay? And you requested for a full refund from the vendor, okay? What account will be journalized to record the return if you are using periodic inventory. So that's the key word, periodic inventory. And you're returning to a vendor.
You debit purchase returns and allowances.
Okay, so if I make a
Credit it.
purchase, right?
Yeah, you credit it because you're doing your, it's accounts payable if you bought on returns or on account.
Okay,
So you would credit the purchase returns and allowances and debit accounts payable.
correct. So in this case, right, when I originally buy my inventory, I'm increasing my purchase expense. Now, in this case, I'm trying to return it because I received 10 broken mugs and I'm trying to reduce my accounts payable, like you just said, right? I'm asking a refund from my vendor. So, how do I do that? You're going to be crediting the purchase returns and allowances because purchase returns and allowances a contra expense account, right? It's going to decrease your purchase expense, right? So in this case, that is correct. Letter B is correct. You're going to be crediting your purchase expense or crediting your purchase returns and allowance, not purchase expense. Okay. Number 22, if terms are 5%, 15, net 30, what does that mean?
I'm gonna shut up for a little while.
All right, so what does terms mean if 5%, 15, net 30?
We can take 5% discount if we pay within 15 days.
Good.
Otherwise, the bill is due in 30 days.
Good. Or you have to pay in full within 30 days, so that is letter A. Okay? You don't have 15 days to pay. If not, you will get fined 5%. No, you get charged, but not 5%. Okay. Number 23. Okay, what does net mean?
We take the discount immediately.
Correct, right? Letter B, you're going to take the discount immediately, right? So in this case, think about your net pay versus your gross pay, right? Your gross pay is everything that you've earned, right? But your net pay is going to be everything that's discounted, everything that's taken out, and then you're going to be left over with whatever amount. So that's the same thing here, right? You're taking the discount immediately, so then when you get your net whatever it is, right? It's going to be discounted already. Okay? All right, moving on to chapter 6, okay? If a customer buys 10 shirts for $5 each and sales tax is 8.25%, total cash sales was for a total of $54.12, okay? If the next day that the customer wants to return 5 shirts because they were the wrong size, okay, then the customer demands a full refund for the 5 shirts. What should the journal entry look like? Okay, assume that you are using periodic inventory. So you're returning to a customer.
We are just doing the portion where we are defunding the money to the customer, correct?
Yes.
So I picked the C because we are doing a sales return and other ones.
Mm-hmm.
We are giving them sales tax.
Mm-hmm.
And then also we are reducing the amount of cash we had.
Yep.
So we're giving them back.
Good. So that's one thing that I just wanted to make sure that you know is that if you're selling a product to a customer and you're charging them sales tax, you need to give them a portion of their sales tax money back for the refund. So in this case, that is correct. Okay, you're not charging the customer more money. Okay, so in this case, you are refunding the money back to the customer. Okay. Number 25, when there is a store-wide sale discount for 40% off, you can only take a discount off of what items? Okay, let me push this question down since there's a D. Okay. So if you have a store-wide discount, what are the items that you can discount?
A.
You can only take a discount off of merchant selling price, okay? You can't discount sales tax, and you definitely cannot discount shipping and handling. The only discount that you can get for shipping and handling is free shipping and handling, right? Because they just saying, well, if you spend more money, then that cost is going to override the shipping fee. That's all that is. But in reality, the vendor itself, the person who's selling it to you, is still going to pay for the shipping. They just save a little money by shipping a whole bunch of things at once instead of having to pay, individual prices. Okay, so that's the only considered discount. But in this case, on a customer standpoint, can you discount shipping? No. Okay, so take that example when I said if you go to FedEx and ask for a discount, they're gonna laugh at you. Okay, so. All right, so this question number 6 here, use the following table to answer the question, okay? So here is what you're going to be receiving. So it's a lower cost of market. So if you purchase something originally costing you $4.75, to replace it's going to cost you $4.05. You originally sell this at $10.50. To dispose it's going to cost you $1.33 each. And then, of course, the amount of profit you want to try to get out of it is $3.55. So, number 1, let's solve for the ceiling price. How do you solve for ceiling?
It's selling price minus cost of disposable.
Okay, so in this case, what is your total here?
So 1050 minus 133 equal $9.17.
Okay, so 1050 minus 133 will give you $9.17.
17.
Okay, so 917 is your number here. Okay. How do you solve for the floor?
It's you take the ceiling price minus profit.
Okay, so in this case,
I have $5.62.
so in this case, your ceiling is your 917 that you took from above, and then
so it's 355, and then I got $5.62.
$5.52.
62.
Okay. Now you need to solve for which one is the market price. So in this case, you need to compare 3 numbers. What are those 3 numbers that you're comparing?
The replacement cost, ceiling cost.
Oh, I'm doing okay. So ceiling, floor, and replacement of $4.05. So which one's in the middle?
Mark the 562.
562 is in between because this time the replacement cost is way too low, right? It's beyond the floor price here. So that means my floor becomes my market. Okay, because I need to choose a number that's in between the 2 numbers, right? So in this case, I got to determine which one's the highest value, which one's the lowest value, and whichever number falls in between them. So in this case, $5.62 is correct. So in this case, last question is, which one's lower? Original cost at $4.75 or market cost at $5.62?
Original cost of $4.75.
Good. There you go. Okay, that's all you have to do is just answer the question, which price is lower, original cost or the market? Okay. Good. Okay, let me see. time is it now? Okay, let's go ahead and go over a couple more and then we'll go take a break real quick, okay? Now we're moving on to chapter 7. Okay, so chapter 7, questions 27 through 30 are related, okay? So make sure that you are aware the next 4 questions. So number 27, okay? If your tracking method is perpetual, okay? And on June 1st, you made a purchase of 100 coffee mugs for $2.35 each, with the freight costing you $100, okay? And you purchased this on an account. Record this transaction. Okay, so today is June 1st. Right? How do I journalize that I'm purchasing coffee mugs using perpetual inventory?
Wait,
Mug,
oh,
yeah,
Got
mug,
your mug.
you get it for $3.35.
Okay?
And payable, you credit for the same.
Okay. Now, in this case, under perpetual inventory, we are going to shove everything into inventory. So, in this case, my purchase price, if I purchase 100 of them, coffee mugs at $2.35, that's going to give me a grand total of $235. But because I'm going to also shove any cost that is related to inventory into inventory, that additional $100 will increase it to $335, which is all going to go directly into the coffee mugs. Okay. All right, let me push this question down real quick. All right. So next question is question number 28. Okay, if on June 7th you received your coffee mugs and found that 2 of them were broken or were cracked, and you requested for a refund from your vendor, how do I record this transaction? So in this case, this is related to the previous one. So how would I record a refund? Go ahead.
Okay, you would debit accounts payable for $4.70 because you can't do delivery,
Okay.
and you would credit mugs for the $4.70.
Okay. So in this case, right, what was the original price that you purchased them at? They were $2.35, right? We're looking at what we originally purchased it. Like Marcy said, you cannot return the freight, so that means you're going to ignore the freight. So if it's going to cost me $2.35 and I'm only returning 2 of them, 2 times $2.35 will give you $4.70. Good. All right, and that's what you need to know. Okay, so if I have letter A, accounts payable for $4.70, and then B, coffee mugs, credit coffee mugs for $4.70, then your answer is going to be D, A, and B. Okay, so make sure that you are aware that you have the possibilities of having a combination between the answers. Okay. Question number 29. Okay, if on June 8th you decided to sell 25 coffee mugs for $10 each, and if it cost you $3.37 each, okay, then assume no sales tax was charged. All sales were made with cash. Record.
You put cash
Mm-hmm.
for debit of $250.
$250 by 25 times 10 is going to
Yes.
give you $250. Good.
And then we credit sales for same amount, $250.
Good, right? We need to recognize that we sold our coffee mugs first, right? For $250. Right?
And then we do the cost of goods sold because it's perpetual.
Mm-hmm.
And so cost of goods sold is 25 times 337
Mm-hmm.
equal to $84.25. And then we also credit the same amount from mugs, the inventory.
Okay. So first thing we gotta do is we have to recognize that we sold the coffee mugs first, because that is the number one thing that this transaction is actually looking at, right? We sold our coffee mugs. We have to sell our coffee mugs first before we can get rid of it out of our inventory, right? Think of it like a grocery store, right? Once that barcode scans, right, and that person pays, that's when the inventory is going to be updated after you sold the product. After you got rid of the product is when you update your inventory. So that's the purpose of this. And because it's perpetual, there's an additional additional journal entry that you must do. Now here, we recognize there's two things that we need to look at, right? First off, what do we sell our product for? That's my selling price, right? And then I need to figure out how much it cost me to sell, which in this case, it cost me $3.37. So that's the difference between the two. They're not the same thing. Okay? Selling price is different than what it cost you. Okay? And then lastly, number 30, okay, on June 10, a customer returns 2 coffee mugs for a full refund, and you sold each coffee mug for $10 each, and of course, it cost you $3.37 each. So record this transaction.
Well, you have the $20 debited from the returns, sales returns and allowances.
Good. Sales returns and allowances is what we're looking at, because we sold to a customer and now the customer is wanting a refund. So we did a sales return and allowance. Okay.
And then cash is credited for that $20.
Yep, we're assuming. Good. So in this case, right, if we sold each cup for $10 and they're trying to return 2 times 10 is $20. And in this case, we didn't charge any sales tax. Okay. And
then we have, well, supposedly we return them because they're not broken. So coffee mugs gets back $6.74. And cost of goods is credited $6.74.
okay, so in this case, that's exactly what we do. We're going to undo the cost of goods sold, right? Because it's as if we never sold those 2 coffee mugs, and we're going to shove it back into inventory. Okay, so in this case, that's exactly what we're doing. And if it cost me $3.37 each, multiply that by 2, because that's the 2 that the customer's returning. That means I'm getting it back. I'm not giving them a discount. They're not keeping the product. They're actually giving me the product back. So in this case, 2 times 3, 37 is going to 674. Okay, so that's something you need to know, that again, even with a refund, if the customer is returning the product back to them, you do need to have that extra second reversal journal entry right there. Okay. All right, let's go ahead and take a look. So right now it is 2:51. I'm going to stop and pause here real quick. Let's go ahead and take a quick break here so we can just finish up the study guide on time.